So, your mortgage payment just went up. Your rate didn't change. Nothing about your loan changed. So what actually happened here? Escrow. That's what happened. Now, I want you to really pay attention here, because this letter your servicer sent you, it looks boring. It looks like junk mail. It is not junk mail. It is controlling a real number on your account, and most people just glance at it and move it straight to the trash. Here's the thing. Somewhere in that shortage is a choice between two very different payments, two very different monthly numbers. And your servicer is not going to sit you down and explain that choice in plain English. I am, so save this video, because we're going in dense today. There are three things that decide exactly what happens to your payment next. Let's start with the first one. Okay, let's start with the basics, because you cannot understand the letter until you understand the account. An escrow account is money your servicer holds on your behalf to pay two things, and two things only. Your property taxes, your homeowner's insurance. Every single month, a slice of your payment goes straight into that account, and the servicer pays those two bills for you, on your behalf, when they come due. Now here's where people get confused. You locked a rate, a fixed rate. So why is your total monthly payment moving around like it's variable? Because your rate only covers the loan itself, principal and interest. It says nothing at all, about what your county charges you in property taxes or what your insurer charges you in premiums. Those two costs are just passed straight through your escrow account. And here's the part nobody actually tells you. There is no cap, no federal limit on how much that pass-through portion can rise year over year, because it isn't a lender fee. It's just real bills, being paid for with real money, plain and simple. So once a year, your servicer runs what's called an escrow analysis. They look at the whole account together as one number, not bill by bill, and they check it against a target balance. Within 30 calendar days of that analysis wrapping up, they are required to send you a statement explaining exactly what happened. That statement, that letter, is the one you're holding right now, and that statement is legal. It's required by federal rule. It is coming, whether you open it or not. So the real question here isn't whether this happens to you. It's why it's happening to so many people at once, right now, in 2026. That's coming up next. So why is this happening to so many people, right now, all at once? Let's go through it. Number one, and by far the very biggest single driver, property tax reassessments. Industry estimates put this behind roughly 60% of all shortage cases. Your county reassesses, your tax bill jumps, and your escrow account was simply never collecting enough to cover it. Number two, homeowners insurance. Roughly 30% of cases, tied directly to the climate-driven premium repricing we've seen hit hard through 2025 and into 2026. And this one is regional, not national. Florida, California, Texas, Louisiana, these states keep getting flagged as the hardest hit. Number three, flood zone changes. Your area gets redesignated and suddenly you need additional coverage you simply didn't need the year before. And number four, plain old undercollection. Your servicer's original estimate right after you bought or refinanced just came in too low before that first annual analysis ever even ran. Now here's the number that actually matters. Cotality, a property analytics firm, reported through CNBC in May of 2026 that roughly 65% of escrow accounts are facing a shortage this year. The average shortfall? About $2,157. Spread across 12 months, that works out to roughly $175 to $180 more every single month. And I need to correct something you might be seeing elsewhere online. Some creators are quoting that as a flat national number every homeowner should expect. That's wrong. That's an average tied specifically to 2026 conditions, not a permanent rule. So now you know why this is happening to so many homeowners at once. But there's one specific word on your letter that changes everything about how serious this actually is for you. Okay, so here's the exact word: deficiency. And I want you to listen carefully here, because this is not the same thing as a shortage, even though people use these two words like they're interchangeable. A shortage means your escrow balance is simply sitting below the target amount. It's a gap. It's under where it should be. Nothing more dramatic or urgent than that, at least not on its own. A deficiency, though, that's different. That's worse. A deficiency means the balance is actually negative. Your servicer has already gone out and fronted real money on your behalf, paid your tax bill, paid your insurance bill, using funds that simply weren't there yet to cover it. They floated you, and now they need that money back. So is a deficiency actually truly worse for you? Generally, yes. Industry sources consistently, across the board, describe a deficiency as more likely to produce a larger increase, a more urgent one, because your servicer is trying to recover money it already spent, not just correct a projection going forward for next year. But here's the important part, the part I don't want you to panic over. Both of these, shortage and deficiency both, get repaid through the exact same mechanisms. Same rules, same options. The word on your letter tells you how serious the situation is. It does not tell you a completely different process is coming. So before you panic, or before you don't panic enough, go check your letter right now, today. Find that word, shortage or deficiency. That single word decides how you read absolutely everything that comes next. And what comes next is the actual rule, the federal rule, that decides exactly what your servicer can and cannot legally do with your money. That's where this really gets real. Okay, so here's the actual rule now. And I want you to really lock in here, because this is the part your servicer's letter conveniently glosses right over. There are two separate rules here, two of them, and which one applies to you depends entirely on a single specific number. If your shortage is less than 1 month's escrow payment, your servicer has real options here. They can let it sit and do absolutely nothing. They can require you to repay it within 30 days, or they can spread it out over 12 months or more. But if your shortage equals or exceeds 1 full month's escrow payment, that's a completely different rule. Under federal regulation, your servicer only has 2 paths available to them. Do nothing and let it exist as is. Or spread repayment in equal monthly installments over at least 12 months, added right on top of your new corrected deposit going forward. And here's something I need to correct on camera because I see this stated wrong constantly online. Your servicer cannot offer you a lump sum payoff option on that annual statement once you're at or above that 1-month threshold. Federal guidance confirms this directly. That option simply is not allowed to appear on the letter. Now, steelman this for a second because it's important. Your servicer isn't doing this to punish you personally. They're following a strict federal rule here, not making it up as they go along. But this is exactly where your intro question gets answered. Remember that choice I mentioned earlier? The one between 2 very different payments? This is it. This is the fork in the road. And next, I'm going to show you exactly what that choice looks like in real dollars, so you know precisely exactly what you're deciding. Okay, let's put real numbers on this, so this stops being abstract and starts being your actual account. I want to be really clear here. This is a worked scenario, using the real average we already talked about, not a specific person, not a specific loan. Let's say your shortage is that $2,157 average, $2,157. Same number as before. Now you're facing the exact fork in the road we just laid out. Path 1. You send your servicer an unsolicited lump sum. Now, this cannot be offered to you as an option on the statement itself. We covered that already. But Regulation X does not prohibit you from sending it voluntarily on your own. You pay the full $2,157, and your ongoing monthly payment stays right at the new, corrected lower level. Nothing extra added on top. Path 2, then. You let it spread instead. That same $2,157 divided by 12 gets added right on top of your new deposit. That lands you right in that $175 to $180 range every single month for a full year straight. Now, you might be thinking, why wouldn't everyone just send the lump sum? Because most people simply don't have $2,157 sitting around free, ready to go. That's exactly why the 12-month spread exists. It's not the lesser option. It's the real option for real people living real lives. So know your exact number before your servicer's letter ever tells it to you. That's the real choice sitting in front of you. And next, we need to talk about what actually happens if you just don't choose at all. Now, technically speaking, doing nothing is one of the options your servicer actually has. We already covered that. They can just let a shortage sit there and reflect it again on next year's analysis. But in practice, though, most servicers pass it right on to you as that 12-month spread increase. Doing absolutely nothing is genuinely rare. And here's where I need you to pay very, very close attention, because there's a much harder floor underneath all of this, and it has nothing to do with escrow directly. If your actual mortgage payment, the whole payment, becomes more than 30 days overdue, your servicer is no longer required to advance funds out of their own pocket to cover your taxes or your insurance. That protection disappears completely, and that can allow real lapses to happen. A tax lien risk, an insurance coverage gap, real serious consequences, not hypothetical ones. And it can get worse from there. If your servicer mistakenly believes your insurance has lapsed, sometimes because of escrow confusion itself, they can force-place a policy on your behalf. And force-placed insurance is expensive. It's lower coverage. It's a policy you never chose. And this, by the way, is itself a common cause of a sudden large escrow shortage the very next year. It compounds on itself. Now, I want to be really clear about something. This last part is industry-reported color, not a stated CFPB rule, but it's consistently reported enough across enough sources that you really need to hear it. So ignoring this letter isn't neutral. It isn't nothing. It can snowball into something much bigger than a simple monthly payment increase. So how do you make sure you're never sitting here again, reading a letter exactly like this one, feeling blindsided? That's exactly what we're covering next. So how do you actually get out from under this for good? Let's talk about the escrow waiver. An escrow waiver means paying your taxes and your insurance directly, yourself, instead of routing that money through your servicer every single month. No middleman, no annual analysis, no surprise letter showing up in your mailbox. But, and I want you to hear this clearly, this isn't available to everyone. It's generally offered only on conventional loans, and generally only once you've built up meaningful equity, commonly cited around 20%, along with a genuinely clean payment history. Sometimes there's a small rate or fee trade-off attached to it as well. It's a real option. It's a legitimate one, but it's not automatic, and it's not guaranteed to everyone who simply asks for it. And here's the correction I need to make plainly, on camera, because people get this wrong constantly online. FHA loans and VA loans require an escrow account, full stop. There is no waiver available. Not with enough equity, not with perfect payment history, ever. If you're in an FHA or VA loan, this letter is simply part of the deal, permanently for the life of that loan. So what do you actually do with all of this? Ask your servicer directly whether you qualify for a waiver. Don't assume, ask them. And going forward, read the statement the day it arrives in your mailbox. not the day your new, higher payment actually hits your account. That 30-day window matters. Use it, because the borrowers who get blindsided aren't the ones who get a shortage. Shortages happen to almost everyone, 65% of accounts this year. The ones who get truly blindsided are only the ones who never opened the letter at all. Don't be one of them. Okay, so I know that was dense. Really, really dense. But you stayed all the way through, and that matters because this is your money, your monthly payment, and most people never get this explained to them in plain English. So here's the refrain, one more time, so it sticks. 65% of accounts short this year. Average shortfall, $2,157. That's not you being singled out. That's simply where 2026 is right now, for almost everyone. The letter isn't your enemy here. The confusion is. So know your word, shortage or deficiency. Know your number. Know your two paths. That's genuinely it. Now, next video, I'm breaking down exactly how to read your annual escrow statement line by line so you can catch a shortage coming before the letter ever does. Go check your last statement right now, and I'll see you there.